My name is Noah Wamalwa. I work in the Public Finance Management Program. And as Jackie had indicated, we undertook an analysis of the GOK Statement of Exchequer Releases. This is a publication by the National Treasury, and it's released, it was released 2 weeks ago. It covers data from 1st of July 2022 to 31st of March 2023. So the outline of my presentation is as follows. We'll have a short overview of the macroeconomic outlook. Mainly, we'll be looking at the economic performance over time on quarterly basis. And then we'll look at the changes in the supplementary budget. So you'll remember that the budget was released. And so we'll also have a short analysis on that. And then the revenue performance trends in the cash disbursement. So we'll first start by looking at the macroeconomic outlook, then changes in the supplementary budget, then an overview of revenue performance, trends in cash disbursement, and then we'll conclude with some key messages. So in terms of the economic performance, the trends show that there was a slump, of course, in 2019, 2020, due to the COVID-19, as you can see. The economy registered negative growth rates. But then the following year, in 2021, it picked up from that low base, registering 11 growth in 2021 Q2. But then you can also see that from that point onwards, there is a general decline in the economic performance. In Q3, we can see it is 4.7, Q3 2022. So there is a sharp decline over this short period. On average, looking at the economic survey that was released yesterday, last year the economy grew by 4.8% on average. So which means that in Q4 there was much lower performance compared to the rest of the quarters in 2022. So we know that economic performance directly impacts on the revenue performance. So because economic performance shows the economic activities that are undertaken in an economy, and so we expect to have an effect on the revenue performance. So the cash crunch that we've been hearing the cash crunch that we have been hearing, or reports by the government and also in the media, partly reflects the poor economic performance that the economy has been registering. Yeah, but partly due to other factors that we'll also cover in this presentation. Yes. In terms of the supplementary budgets that were released in February, when we compare the original budget estimates to the revised, we see some key features. The first feature that we see is that the tax revenue increased. That is, the government, the current regime was over-optimistic in terms of raising the revenue. It revised upwards from 2.07 trillion to 2.11 trillion. Now, we also see some shifts in terms of the borrowing. The domestic borrowing, we see the government estimates to collect relatively less from domestic, but relatively more from the external loans. That's why you see external loans having been revised upwards, 0.35 to 0.52. For the Yes, for the entire period. Then in terms of CFS, CFS is the Consolidated Fund Services. The major component within that is the public debt, which accounts more than 90%. The second is pensions and those first charges. And then we have other deductions that are within CFS. So we see that CFS component largely remain the same. And the reason why it largely remained the same is because it is a first charge on account. It is mandatory. And so we don't have much flexibility on the budget. Now, when we compare between national government recurrent budget vis-a-vis development, we also see some interesting shifts. For recurrent, the budget increased upwards, but for development, it was revised downwards. So the net effect, there was overall increase of about 58 billion shillings, but that was at an expense of development budget. For counties, it was 370 billion, that is the equitable share, and we have additional 29.6 billion, the balances from the previous financial period, 2022. Yeah, so yeah, this is what we see in terms of shifts of priorities in the supplementary budget. Now, this slide shows us the disbursements against the revised budget estimates. We want to compare for the first 9 months from 1st July to 31st March. How have the revenue performed against the total revised estimate? So whereas the revised estimate for tax revenue was 2.11 trillion, the actual revenue collection or receipts is 1.39 trillion. Yeah, which shows a gap, although we are not at the end of the year. For domestic, we also see a gap about 0.4 trillion. External loans, there's also a gap. So all the rest, we have gaps. And we want to see if, for example, we assumed even distribution or even distribution of the collection and even distribution of the disbursements, what are the shortfalls up to the end of the 9 months? Yeah, so that is a bit that we'll be covering in the subsequent slides. Yeah, now maybe before we go into those specific differences, we want also to look at the specific tax heads. So when you look at the first bar, the tax revenue, we see that gap. But this chart does not tell us the components of taxes within that are leading to those deviations. So what we've tried in this chart is to show the data that was available was the first 6 months, that is 1st July to 31st December last year. And when we compare between the target against the actual, we see deviations. Yeah, the total tax revenue, we see deviation of 11 billion. Ordinary revenue, we see deviation of 43 billion. That is column 5. Column 5, 11.186. That is 11.2 billion. Then we have 43.2 billion. That is ordinary revenue. For import duty, it is 1.5 billion. For excess duty, it is 8.7 billion. So most of the tax heads, we had shortfalls, which correlates with the poor economic performance that we have seen across the quarters. Yeah. So we saw a sharp decline of the economic performance, 6.7 quarter one to 4.7 quarter three in 2022. So there is that is impacting on these shortfalls in revenue across the period because of the reduced economic activities. So apart from just looking at the deviations for the first 6 months, the positive thing is that the actual revenue that was collected in 2020-22, 2020-22-23, that is column 3, when you compare it with column 2, 2021-2022, you find that there is a growth. Yeah. So generally, what this tells us is that this target may have also been overly optimistic. Yeah. So we have combination of two factors, poor economic performance, and then we have another factor, which is the government being overly optimistic. Yeah. Which we think then it impacts adversely in terms of revenue, fund disbursements to the agencies. Yes. Now, as I had said earlier, if we assume even distribution of the collections, and we also assume even distribution in terms of the disbursements, we want to know the gap up to the 9th month from 1st July 2022. Now, the first part of this chart tells us that the actual revenue realization, tax revenue realization, was 66% of the revised budget estimates. Now, the gap up to 75% is 9%. The following bar shows the gap for the domestic borrowing. So we have a gap of 30%. The third is external loans. We have a gap of 30%. Yeah. Then in terms of the disbursement of cash, CFS, disbursement to payment of public debt and pensions, the gap is 18%. National government, the total national government, the gap is 15%, of which national government is 11, proportionally national government is 11%, and national government for recurrent 11%, national government development is 31%, while counties is 22%. Now, on the revenue side, we find that the biggest gap is in terms of mobilization of revenue from domestic borrowing and also from external borrowing, which means that the environment for mobilization of funds is deteriorating, is becoming unfavorable over time. So the negative macroeconomic indicators are impacting negatively to the environment for collection of revenue. Yeah. So that's why from the domestic market, government is not collecting enough from, let's say, commercial banks and what have you. Yes. Now, on the disbursement side, we see it is development, national government development budget, and counties that have the largest hit in terms of delays in the disbursement of funds. Yeah. Now, this chart we like to estimate those gaps in terms of the amount. Yeah. So in terms of the amount on the revenue side, we see we have a gap of 269. Yeah, up to the 9th month, we have a gap of 269 billion on the domestic borrowing, while on external loans, we have a gap of 155 billion, while the tax revenue, we have a gap of 188 billion. Now, when it comes to disbursement, the largest gap in terms of the nominal value of the disbursement is 278 for CFS, Consolidated Fund Services. Then combination of recurrent and development is 255. Counties is 87. Yeah. Now, we also did look at these gaps in terms of months. That is, how many months will it take for the government to collect that revenue? In terms of months, we see that on the revenue side, it will take approximately 3.6 months to raise the balance for domestic borrowing. And then it will take around 3.6 to collect the balance for external loans. While for the overall tax revenue, it's about 1.1 months. Then on the disbursement side, the largest or the longest time to collect the balances will be on development, while counties, it will be 2.64 months. Yeah. So generally what this chart tells us is that the development part of budget for national government and the counties are the most hit, or the ones that the national government has delayed the most in terms of disbursing the funds. Yeah. Yeah. So from this point on, I would like to invite Kwame, who will take us through the additional effects on the supplementary budgets. Yeah.
All right. Okay. Thank you, Noah. I'll just put on my mic so people can see which face is speaking. But because my connection is slow, I'll just I'll switch it on, switch it off as soon as this is done. So let's start with what our purpose is basically to take a snapshot of the public domain by the National Treasury and ask ourselves two questions. The first question is, what does it tell us about the government state of finances, at least in terms of budget accomplishments and expenditure for the year? And the second part is to try and lead us to a coherent story about what's causing the disbursement delays and how serious is it. So I'll start from that before we go to the next slide. So let's keep it back. We remember in slide number 7, Noah gave us two things. It is clear that there's a gap in terms of collections, or rather in terms of the government's funding, yes, here. So it's very, very clear, reading on the green side or the left side of the picture, it's very, very clear that tax revenue is 1.07 months behind. Now, the assumption we're making is if you split all expenditure over 12 months, because government budgets are made over 12 months, it's telling you that at the end of March, the amount of revenue, tax revenue, for the purposes of funding the entire budget, on the basis of tax revenue was 1.07 months behind. So what the conclusion you should make from that is, because we have only 1 quarter or 3 months more to go, government will be required to collect the equivalent of 4.1 months within the next 3 months in order for this balance to be achieved. That's the way to interpret this picture. On the part of domestic borrowing and external loans, remember government funding comes from revenue, and then of course the loans, both the external and internal. On the part of loans, you can tell government is even much further behind. Domestic borrowing is 3.64 months behind. External loans were 3.57 months behind at the beginning of April. What this tells you again is, in order to close with a balanced budget at the end of the year, balanced expenditure at the end of the year, it would require government's domestic borrowing in the last 3 months to raise the equivalent of 6.64 months of borrowing, and for external loans to raise the equivalent of 3.57 plus the additional 3 months. So that's the addition. We wanted to do that because budgets are also expended within time. It tells us how much time is available for these budget numbers to be closed, because that has implications for how those delays in payments, whether it be salaries or development work that government needs to do, will be done. So that's the revenue side. We'll come to a conclusion about how ambitious that would be, but you can tell on the revenue side, it's 1 month behind, 1.1 months behind. On the borrowing side, that's where the bigger gaps might be. So you might ask yourself, why are these big gaps here? And it's very, very clear, because this is borrowing. It's suggesting to us that government has had difficulty borrowing domestically and externally. And that might have something to do with domestic conditions, the interest rates. Also towards the end, actually this went in on to April. In April, government floated some bonds, and every time the yield was much lower in terms of the response relative to what was required. So that's part of what is creating this. So government is having problems borrowing the money that was intended to be borrowed according to last year's budgets and the appropriation accounts that were passed. So that's the first thing. Why? This has something to do with, of course, government's debt obligations, the credibility, the interest rates, and other global things that are happening, suggesting to you that many people or lenders, commercial lenders, whether domestically and externally, are reluctant to lend to government at some of the rates that were suggested, or at all. But it's very, very clear that the main problem is both on the domestic side in terms of tax revenue, much less, but it is far, far higher on the side of domestic borrowing and external loans. So one of the ways in which the present stress will be resolved is, how do we close that? How do you close the external loans and domestic borrowing gaps? And how do you close the tax revenue gaps as well, for everything to balance? But how has government responded on the disbursement side? So the bars in blue or gray. So we know that the consolidated fund services are called first charge on the Constitution. So this is non-discretionary expenditure. You'd expect, therefore, the government, in obeying laws on constitutional requirements, would adjust by delaying other discretionary spending. And they've done that. How have they done that? By delaying some of the stuff related to CFS. So CFS, which is a consolidated fund services, debt payments, pensions, and paying constitutional office holders, are 2 months, 0.15 behind. National government's total is 1 month and 85 tenths of a month behind. And the recurrent, of course, is 1.28. So obviously, you can tell for all institutions, the national government's recurrent balance is least, suggesting to us that the national government has actually privileged payment of its own workers or its recurrent expenditure above all the other priorities that exist, including the consolidated fund services. And that's a significant legal and constitutional question to ask ourselves. Then when we go to the national government development, how have the disbursements been made? You can tell that the adjustments are actually being borne largely by national government suspending development. And this was explained, I think, towards the end of the year and early this year, that new development expenditure is frozen for the while. That's understandable. But it looks as if government, or the national government and the treasury, seem to think, the executive side of government seems to think, that county government expenditure is discretionary spending. So in terms of counties, they are almost 3 months behind, equivalent to a whole quarter. No wonder we had the Council of Governors together with, Council of Governors, of course, coming down to announce that they are unable to pay and they might have to close down. So this is a question about, there's a shock on the revenue side, regardless of what has cost it, but the adjustment is disproportionately borne by county governments and a suspension of national government development expenditure. So with that stated, let's go now to what are some other implications that we saw from the data that Noah has brought to us. So in the next slide, yes, so what are the additional effects? Yes, so let's come here. Now, Noah has given us an adjustment that came about. One of the big things that the new administration came in, a difficult moment, but the new administration came in, showed a consciousness of the fact that public finances were in a bad place. And among the things that the president went to Parliament sometime in October, told Parliament that there'd be an adjustment of spending to cut back 300 billion. I mean, my eyes popped out. Speaking for myself, my eyes popped out. 300 billion would have been significant, and that was definitely signaling in the right way. I was wondering whether there'd been consultation with people in the Treasury and other arms of government. So the idea that has caught up with Kenyans is that this new administration came about here with a pair of scissors or black pen and actually cut down substantial amounts of revenue. The reality, as this slide tells us, is it's not true, both on the recurrent side and on the development side. So let's look at it. Now, what you have here is additional expenditure. Remember, the budget and the appropriations were passed by the last president and signed before the elections. So the new administration came in and was bound by appropriation accounts that had been passed by its predecessor, to the extent that you can say that this new administration is different from the last. So what we have here are 13 new expenditure items that did not exist in the last budgets, but which were introduced in the supplementary budget presented in February by the new administration. Which ones are those? Starting from the National Police Service, an additional 24.6 billion. Obviously, you'd had the conversation that the president made. The administration said that their intent to give the Kenya Police Service its independence of budget management. That was not cut from existing budgets, but it was introduced an additional 24 billion shillings. It is equivalent to 1.94% of estimates based on the last budgets that had been passed by the last parliament. And then the State Department for Internal Security and National Administration. So you see all the way Ministry of Foreign Affairs, State Department for Foreign Affairs, Forestry, all the way down to State Department for Irrigation and Office of the Prime Cabinet Secretary. We know why that 770 million shillings is being spent. It's because this office did not exist. So whenever a new office was introduced, obviously a new budget item was attached to it, as opposed to cutting budgets from other areas. So this is not a cutting government. An additional 46.45 billion only on the recurrent side. So remember, this is mostly paying for wages and that kind of remuneration. So an additional 46 billion. Remember the promise of 300 billion cuts? We'll be seeing whether that is true or not. So this 46 billion shillings, 0.45, represents an additional 3.67% of the revised estimates for the recurrent side only, not the entire budgets that have been passed, for an additional 46 billion. Let's go now to the next slide. In slide 9, we'll see the recurrent, the expenditure, the supplementary, the development side. So we talked about the current expenditure, it suggests 46 billion. On this side, an additional expenditure for 7 units. So what this tells you that we had 13 on the other side and 7 on this side, suggesting that some of the additional expenditure that we saw was not accompanied by development expenditure. Understandable, perhaps. So which institutions or which budget lines received additional spending on development, which means they'll be doing some development work. So we start here with Internal Security and National Administration at 8 billion, all that coming down all the way to 12.71 billion shillings. So that was 45, 12 billion here. So 47 and 12, an additional 60 billion shillings of new expenditure that was not programmed for under the last budget passed by the last parliament and signed into law by the last president. That represents an additional 3.23% of recurrent, or rather of development expenditure. So remember, on the supplementary budgets, the recurrent expenditure was 46.45 billion addition, and here development expenditure is 12.71 addition, suggesting that there's an additional, so this is 3.23 and 3.63, about 3.5, close to 4% additional expenditure. Resolves the question about whether this new administration cut budgets. It did not. In addition, spent 60 billion shillings more, and you've seen that. So we go down to the priority disbursements. In slide 10, yes. So in slide 10, what we tried to do was to ask ourselves, based on what was the supplementary budget which was passed in sometime in early March, because the big question right now is to what extent have funds been disbursed, which is basically based on what has been passed. Where has money been spent, or where has exchequer releases, as budget language states it, been made? So who has received in terms of the ministries, departments, and agencies, and what share of the money that was budgeted for them has been received? And so you see, starting at the top, the State Department for Crop Development and Agricultural Research, 121%. And you'd ask yourself, How would they receive 121% of the equivalent? Remember, up to until March, they should only have received 75% of the, assuming an even sense, an even distribution. So it's already more than what was budgeted for, and we mark it out in red because it suggests additional expenditure even beyond what the supplementary budget had provided, which is curious. The Ministry of Foreign Affairs already spent 93% of their total for the year for the first 9 months alone. So it all goes down back to the Witness Protection Agency. Again, if you see a pattern here, it's the State Teachers Service Commission, which should be at about 75%, at 68% of total expenditure. This was at the end of March, suggesting obviously that it was a few months behind in terms of expenditure. But as you see, State Department for Crop Development and Agriculture Research, you can tell this is where perhaps the subsidies on crops, all those new imports for flour, and all the things that government has done has probably been parked here. And it's already spent more than its budget. So that might raise an audit query in the when the Auditor General comes, but that's for us to see. And you can see what's been privileged: State Department for Interior and Citizen Services, Police, Ministry of Foreign Affairs. I do not understand why. Cooperatives, obviously, some of the cooperatives and agricultural extension is something that this administration has privileged. But you see that it comes all the way from 121% all the way back to 68.4% for the Witness Protection Agency. I think the Witness Protection Agency needs advocates for its cause. Clearly, it's not the priority for so far. So what are our key messages? So if with all that background, we've looked at the data, we've looked at what the disbursements look like, and we've tried to measure it by weighting the disbursements to the number of the disbursements and the revenue to the number of months based on the data that was pushed out. So what I think it's clear that economic performance has deteriorated after a rebound, and that is essential because when you look at the budget numbers that are released now, there's an assumption that growth will touch 7% or thereabout 6.5% to 7%. We think that, as Noah showed in the first slide, growth rates by the quarter, even at the end of last year, were going down. Were decreasing, a secular trend in our view for the year. The rains have come in this year. They came in a little late. The harvest might be good, but obviously global affairs which are not in our control might drive movements the other way. So we are not too sure that an assumption of 6.5%, 7% growth is even realistic. Half of that would probably be it. Our view is that perhaps 4.5% would be a good one to estimate. So obviously that is important because assumptions about growth rates lead to assumptions about incomes. Lead to assumptions about revenues, which create even bigger deficits. And we think that error, which has been made in our earlier administrations and years, seems to have carried forward, and that worries us. Revenue shortfalls, which have been driven partially by poor economic performance, but also unrealistic budget targets, revenue targets. We think this year has even more revenue targets errors in our view. Very, very optimistic. Thomas mentioned that, so I shouldn't log it further. I think it's clear that the overall flexibility of the budget is constrained by high consolidated fund service. In other words, what we are saying, pensions payments together with the large public debt charges, obviously, are claiming such a huge amount of total expenditure and revenues. For that reason, budget flexibility is constrained. That's a clear one. Now, in the data that you saw, one of the other places that actually suffered, so we saw that county governments had received only 53% of what money was due up until the end of March. I think Noah showed that, but didn't emphasize it. So let me emphasize it. Within the consolidated fund basket are 5 main things. One is public debt repayments. 2, the payments for pensions, which is a big one and has been rising as well. By scaling payment for pensions by 12 months, we found out that the equivalent that has been paid in terms of pensions was only 31%, suggesting that it had not even paid for up to half. So one of the harshest cutbacks on the consolidated fund basket is for pensioners. And this tells me that there are some pensioners in Kenya who probably have not received, remember, these are public sector pensions, not NHIF, public sector pension income earners who are retired have probably not received their money since September of 2022. That's grave. I think the other point is supplementary budget obviously shows that the GOK was overly optimistic. So while the rhetoric was on the one side that, look, we understand the pressures that come with the fact that the last administration did this and this, there was optimistic revenue targets, even if revenue was only one month at the 9th month stage behind. But obviously we think it is, and there's an assumption this year as well, brought together with the public finance bill that we'll be discussing lately, but we think that the era of consistent revenue prospects, overestimation of revenue prospects, carries forward as Kenya's part of fiscal policy path, and we think it's dangerous. Now, supplementary budget, of course, shows that the GOK's priority on recurrent spending, it's prioritized recurrent spending, and we understand why. Wages was even expanded, regardless, in spite of the fact that there was supposed to be a revenue cut of 300 billion. Instead, 60 billion new shillings was spent. Remember that 60 billion shillings new expenditure is equivalent to about 11 or 12 days of revenue generation. And county governments and development components of GOK are proportionally disadvantaged because they've had to take the harsh adjustment of this cash crisis that the government of Kenya has made. So as I conclude, the idea is, I mean, you can answer for yourself whether GOK is broke or not, but that is dependent on going to slide 7. We won't go back to it. We'll send this with everybody and asking yourself whether in the next 3 months, of course, we now have 2 months left, actually 1, the government of Kenya can close 3 months of revenue with 4 months, 3 months of time with 4 months of revenue, 4.1 months of revenue. And on the domestic borrowing side, 6.6 months worth of domestic revenue borrowing with 3 months left. Or on the external loan side, 3.57 months, 3.57 and another 3, almost 7 months worth of revenue in 4 months. We think that's a big deal. But if it's achieved, that's fine. So that's what to look for about whether to say whether GOK is broke or not, regardless of what the new budget estimates say. And my view is that it's not a good picture. Thank you very much.
Right. Thanks a lot, Kwame and Noah, for that presentation. So in the last slide, Kwame has done a summary, basically, of the key messages. But just to reiterate that our 2 speakers have taken us systematically through understanding the fiscal data of the current financial year, starting with looking at broadly the general economic growth rates and basically the performance of the economy. They've helped us understand the performance in terms of the revenue, and we've looked at that cash disbursements for the MDAs across in comparison to the revenue. And then Kwame has come in and looked at the effects of the supplementary budgets. So overall, what does this data tell us? And he summarized by helping us understand that maybe contrary to part of the rhetoric that has been there with regards to the budget cuts and the austerity measures that we've had discussions on, the data tells us a different story, because in addition to what had the estimates that were there, we've seen additional expenditure both on the recurrent side and also on the development side. So that's the actual evidence that we have in terms of the data. So thanks to the 2 of them for that presentations. I'd like now to open up the discussion to plenary. Question, if there's any clarification that you'd like from either of our speakers, please raise your hand and I'll be able to see it. You'll have the opportunity to ask your question. As I also look at the chat box to see whether we have any questions here. So I invite anyone who would like to ask a question verbally, please raise your hand and I'll see you. But I think I can start with the one here by Willis. Willis Nalwenge asks, does the revenue collection, that is a month where we see accelerations? So I think Noah and Kwame, both of you will respond to that. Before I allow them, does anyone want to ask? I do not see any hand up. Any clarification, any question? Okay, as you plan to ask your questions verbally, I think I'll start with Noah what are your views in terms of whether from the trends in the data, the current and previous, whether there is any particular months usually where we see better performance in revenues than the other?
Yes, thanks, Jackie. Yeah, when you look at the economic performance across the quarters, it differs. And so does the revenue collection. So all the quarters are not uniform. There's a tendency for higher collection, especially on in quarter two, that is 1st of October to 31st of December, but also towards the last quarter, quarter four, from 1st April to 1st April to 31st June. No, but this is not only affected by the economic performance, but it's also affected by the filing. The tax administration or tax policy that is there that governs filing of returns, for example, and payment of key taxes. So that's, all these factors then lead to those differentials in terms of revenue collection across the quarters.
Kwame?
Okay, so the question from Willis is basically, yes, it's true that taxation revenues don't necessarily flow evenly, as we assumed. But I think what our conclusion still tells us is that in order for that gap to be filled, on slide 7, it would require government in the last one quarter to raise an additional 1 month worth, which means that because government usually collects about 6 billion per month, right? It means that in the next quarter, it would have to raise 33% more than the other quarter that year. And that looks to us like unless some really, really big bust happens, that looks to us like a big commitment. It could happen, but it's a big commitment. There's a question as well by Adrian, and Adrian is asking, Jackie, let me respond to him. Adrian is asking whether the president and sometimes his deputy tout 3 trillion in tax collections. Possible to convince yourself that you can ask for 3 trillion in tax collections in Kenya, bringing it to about 10 billion worth of collections per day. And maybe that's possible, 8 or 9 billion worth of collections per day. And maybe that's possible, but the cost of that is what I'm not too sure is there. And I also think that you would not be able to collect that tax from Kenya's working people. And remember, a disproportionate share of Kenyan taxation is actually collected from labor. We see that has been proposed, and I think it's raised a lot of discussions, massively, but also rightly so. We think this is a bridge too far. And in my view, it's not just a reflection of what confidence they have in the economy, but it's a reflection of how they intend to use government's confiscatory power to actually try and get that. And I'm not too sure that will happen with the growth rates falling, the kind of difficulties that we've seen this year. And while the rains have come, the food situation is not going to ease as usual up to much later in the year, and government spending. So in my view, it's a reflection of their hope in expanding government size, as opposed necessarily to whether you activate new economic activity to be able to collect about 10 billion shillings per day, per working day in Kenya. In addition to that, I think it would be too large. Speaking like that, while at the same time conceding that there's a lot of from two sides of the mouth. So basically, we'll just open the tap and make sure that it flows at a bigger pace. And that's extremely reckless form of fiscal policy management. Thanks.
Great, thanks, Kwame. So we have a hand up. I see a hand by Dr. Fred Amonya. Could you please unmute yourself and ask your question?
Hello, can you hear me? I hope you do. This is to Kwame. Now, Kwame, we cannot divorce the fiscal challenges of Kenya today from infrastructure. So my question, what is the take of the ordinary Kenyan? Does the ordinary Kenyan relate the challenges the country faces today to the infrastructure investment of the past few years? Thank you.
Thank you. I think that was a pretty specific to Kwame. Does anyone else have a question that you'd like to ask? Please raise your hand. In the meantime, Kwame, please go ahead and, okay, sorry, just hold on. So BM, I don't see your full name. Maybe you can reintroduce yourself. BM, ask your question. Unmute yourself and please ask your question. We can't hear you. BM. Okay, Kwame, I think just respond to Dr. Amonya first, then we can proceed.
Yes. Dr. Amonya, you're right that the fiscal difficulties in Kenya are partly related to the infrastructure investments that have been made over the last, more than 10 years, or close to a decade. But it's not just that. I think the fiscal, the debt, the justification for expanded debt was explained by the need to expand the fiscal, to expand. But and actually the collections and the rise in collections and the tightening of loopholes and the collection of revenues, which also fostered the idea that government can never go broke, and the wastage, which we now see that has appalled many people who studied the government and knew the government was corrupt and wasteful. But when they go back then, they say it actually defies belief. Suggests to me that it's both a question of not just the debt, but in addition to that, wastage, which is always justified by the fact that if you collect a lot more money, then government is able to spend. So obviously, it's leaking it's a big leaking bucket. But at the same time, government tries to fill it up by actually having a wider gauge pipe in order to make sure that more water falls in. So it's both, yes. So infrastructure is that. Now, what do Kenyans think? That I don't know. We must remember that with the expansion of the expressway, which came to bear the signature or the talisman for President Kenyatta, most of the infrastructure that was built in Kenya was actually popular among the politicians, let me say in parliament, and also popular among the Kenyan public. And I say this because a couple of, much long ago, when I still and my colleagues at the Institute of Economic Affairs believed that the SGR and the last mile projects were actually wasteful forms of expenditure. While the logic for them was real, there was no way they were going to pay for themselves. So the last mile almost brought a monopoly power company to bankruptcy. And the expressway, or rather, the standard gauge railway, which many Kenyans still like to ride on, but was a part of that investments, were really popular. I think it just turned when this public tax question became a little more political, and there were differences within the party that was in administration at that time. So one side used it, in my view, successfully against the other so that somebody could bear the gain. But the belief was Kenyans love infrastructure as well. And the belief that if you light infrastructure in hearts, in say a place in CI, you're creating development regardless of its cost, is one that I think Kenyans have not enjoyed it. Nonetheless, we'll learn that lesson the hard way, as we soon will learn again with what we call the Hustler Fund. But that's a conversation for a different day. Thanks.
Thank you. Thanks, Kwame. I see an additional comment by Adrian. I think he's very emphasizing the same point because he seems to ask whether bad deficits are a reflection of bad investments. If I get his comment right, and I think that's probably what you've answered. But if you have any additional comments, I think you can respond to that. I still see a hand by BM. I don't know your full name. If you're here, could you please unmute yourself and ask your question?
Please confirm you can hear me now.
Um,
Can you hear me?
yes, we can hear you. Raise your voice and ask your question. Thanks.
Okay, great. Name is Bachel to me. Question is, so what's your view in terms of the possible adjustments and outcomes, cognizant of the current environment that we are in, which means that revenue performance is unlikely to come for the close of the financial year, whereas debt performance is likely to tend to by some form of balance. So given that it's unlikely that revenue and debt collection to meet the requisite targets before the close of the financial year, assessments.
I'm so sorry. I think I'm going to ask you a question again. We didn't get it very clearly. For some reason, you seem to be breaking, but I think you can just try again, and then we'll try and see if we can get it clearly.
Okay, any better?
Yes, now certainly better, please.
Okay, thanks. So my question is this: given that things don't look particularly great, it's unlikely that revenue collection performance is going to improve over the next 2 or 3 months, or basically to the close of the financial year. And same applies to government's ability to raise debt if the auction performance numbers are anything to go by. And given that confidence is also quite low, it's unlikely that the performance on the debt collection side will improve. So given that this stress will likely remain over the near term, what do you think are the further adjustments or outcomes we can expect based on the current scenario? Thanks.
Thank you. I think we got that clearly now. I'll invite Noah to attempt to take it first, and then we'll go to Kwame.
Yes, thanks. Thanks, BM, for your question. Yeah, yeah, I think it's clear. I mean, I agree with your comment in terms of the poor economic environment, which is leading to underperformance of revenue. And we think that this challenge can be managed, especially by setting realistic revenue targets. So when the economic performance is deteriorating, as we saw on quarterly basis, while the government is raising the targets of revenue, we think it is misaligned to the economic realities. So it's likely that the 2.11 that had been projected may not be met. Of course, we said in Q4 there's likely to have more revenue collection, but remember we are 1 month behind in terms of total revenue collection already. So that is likely to impact in terms of not meeting the revenue targets. But we think that the government needs to have better models, especially the revenue forecasting models, so as to reduce all the adverse effects that delays in the disbursement have had on the departments and even the counties. So, for instance, the National Treasury can in advance tell the counties to adjust when they forecast of in terms of the likely revenue shortfall. For example, for the counties to prioritize, for example, in terms of salaries and operations and maintenance, and to delay, for example, the development part of the spending. So yes, we know already there will be some constraint because of some of the spending items that are mandatory, for example, pensions and the public debt servicing. But we think that it can be managed nevertheless. So we also think that the government can go into negotiating some of the huge loans that have been borrowed, so that to buy some time from smooth settling of those public debt. Yeah.
Thank you. Thanks, Noah. Kwame.
Yes. Yes. Like UBM, I'm also very, I mean, I have to be optimistic and hope that a good public rate, if I may use that as a metaphor, by KRA would get in sufficient revenue. But it's unlikely to close the tax revenue side, the domestic borrowing and external loans all together in the quarter that is left, suggesting to me that the next budget season for the next year is going to start with a lot more stress in the way, because the budget is one, this fiscal stress is going to be transferred into the next financial year regardless. And that means that a management based on every day or trying to put off one fire actually up here. The government of Kenya, through the Treasury's advice and some of the communication that I see, is relying on the ability to refinance. I think towards later this year, as the next budget season starts, the one after that. Some of that may not come forth. I hope it does for our common sakes. If it doesn't, I think it is time for the government of Kenya to begin to speak the language of restructuring Kenya's public debt. Not place our pride and to pay. Already, if you have 2 months of salaries arrears, you're already in default. If you're not paid suppliers for years, months, that is default. It's just a technical form of managing. So I think we need to get national pride out of this and talk about what does a called rational economics and financial management analysis tells us. And my view is we are as close as is possible to it. And just making one quarter worth of revenue is not going to sort out. I just have to say that if at any one time in my profession I've ever thought that the option B, which is to open up and to start to call people, including the IMF, whose boss was here a couple of months ago, and tell them, look, we'll give ourselves one quarter and we might be calling you. So you can put together a meeting of our debtors for us to talk about restructuring, and calling some gentleman in Southeast Asia whose companies sold us trains and telling them, look, we need to actually discuss this. I think that is an option that is not off the table. And in my view, between last year and today, I think Kenya is closer to a restructuring and a default than it's ever been in my professional life. There are not too many tricks left in the table, because if you look at what Sri Lanka did, Ghana did, Zambia, when they faced the same problem in other parts of the world, the kind of new and very innovative policy proposals that we have. So for instance, the government, after missing 2 bond issues that were undersubscribed, one was taken off the table, has come up with, and they may or may not work. But even then, a 30 billion shillings bond, in my view, is not sufficient. It just simply buys us time. So this is now a structural budget problem. And that's why I disagree with people who think it's a liquidity crisis. It isn't. This is a financial crisis coming, and we need to see the end of the tunnel. But it's not, I mean, we need to see the train coming. We must take much, much more than simply thinking that you can manage it month by month, paying salaries and catching up. perhaps we need to stop digging. So that's it. So I'm not saying it's happened, but I'm saying it's closer than it's ever been before. And blame not with the executive offices, the cabinet, and parliament themselves need to be a little bit more prepared than I think they are now, and be candid with each other than I think they have been so far. Thanks.
Thank you. Thanks, Kwame. In addition to that, I think Adrian asks whether it's you foresee a default on external or local debts, or both. Yes. So I don't know whether Noah would like to take that. Does anyone else have a question that you'd like to ask verbally? Please raise your hand. Okay. Well, I think I do not see any additional questions. Giving the last opportunity for anyone before I invite our two speakers to give their closing remarks, and Kwame particularly to also respond to that last part, whether if we were to have that default, it would be on the external or domestic facilities, or both. Because I do not see any other questions, I think I'll just invite Noah to start with his closing remarks, and any last comment, and then I'll come to Kwame.
Yeah, thanks. Thanks everyone for joining us, for your participation, and thanks for the comments that you have shared. Yeah, so generally, in summary, we see that Kenya is facing some economic challenges, and this we see has impacted on the revenue mobilization. However, we think that there's a mismanagement component that has led to the cash crisis, for example, that we have witnessed. So there is room for improvement on the government side to ensure that even if even if we are in this budget constraint, there are some things that the government can do right so that we mitigate against the adverse effects. Yeah. So and especially most of these challenges that we're facing now, there are challenges that have accumulated over time. I mean, the mistargets that we had over time have led to these challenges that we're experiencing. And the key issue that we notice is the consistent budget deficit over time. For the last decade, we've been running a deficit budget. So it has led to serious reduction in the fiscal space. So going forward, we call for more prudent management of finances, but we also call for, part of that is to ensure that waste is reduced within a government, so as to create more room for the fiscal space. Yeah. So going forward, we will compile this into a brief and also share with you along the presentation. Yeah. Thank you once again, and have a lovely evening.
Thanks, Noah. I see one last question on the chat box by Peter, who says that he has two questions as to debt obligations over the next 14 months vis-a-vis external borrowing targets. Do you have any indication of the terms under which GOK is borrowing $3 billion from the Afrexim Bank, as this appears to be a short-term facility? And has IEA prepared any models on expenditure cutting options under the current revenue gaps? So I think, Kwame, as you give your closing remarks, you can attempt to take that.
All right. Okay. Thanks, Peter. But let me talk first about, there's a question on the chat box from Adrian about whether the default will be an external or foreign. Look, so Kenya's debt is very interesting for two reasons. it's almost at a 51, 52% external and 52%. I mean, and 48. It's almost 59, 41. Usually very, very close. Of course, a little bit 51, 49, 51 external, 41 internal. But when you look at the problem in Kenya's debt, in my view, is not necessarily. Yesterday, the cabinet secretary stated that if a country borrows at an interest rate that's higher than its growth rate, then it's going to run into liquidity problems. He says liquidity problems, actually debt problems is perhaps what he should have said. And everybody applauded that as if that's an extremely profound statement. It isn't. In fact, that's what's happened before, and that's a mathematical truism. So it doesn't require several PhDs in economics to understand that. But the public appreciated it, and I accept that. Now, so while for 51%, the last time we checked, of money that is owed, which is more than 10 trillion Kenyan shillings, is well above that, is owed to foreigners. In terms of interest payments, 80% of the interest that Kenya pays every year, including this year, is owed to domestic banks. And that suggests two things. Government of Kenya has been borrowing externally and internally in equal measure. So the problem with that, Kenya's debt position and distress, is not an external one or an internal one. It's both. It's an external one only in terms of the risk of exchange depreciation, which is still going to happen because yesterday the Fed in the US raised interest rates. That's going to strengthen the dollar even further. And obviously that means the Kenya shilling is going to depreciate much more. So that's the fight. Domestically, many Kenyan, whether it's pension funds, whether it's banks and everybody else, most of the debt, they bought debt as a very safe instrument and all that. So it would be very difficult if a restructuring would come, touch wood, but if a restructuring would come, it's difficult to convince somebody, a commercial bank in the US, that they should take a haircut, which means you have to you have to convince them to take a review, a downward adjustment in their payments, while domestic banks, which are taking 80% of the interest payments, do not. I think the risk profile just suggests that the external risk in terms of exchange risks mean that obviously we'd have to pay more for the external one, but domestically, the interest rates that the Kenya government has been giving to domestic banks and all those who buy government paper is part of the problem. So I don't think a default can be one side or the other. It's a difficult thing, and usually a restructuring is not something that should be gone into easily, but that's why it's also necessary, because countries delay it until it's too late. Sri Lanka did the same, so did Sri Lanka did the same, so did Zambia, and so did Ghana. So that's it. So I don't think it'll be a default of one or the other. It will just have to be probably a haircut. The only part of a debt that is usually subject to no excision or no adjustment, and no adjustment is usually for multilateral debt, which are those global taken out fast, and then everybody else will then have to negotiate how to take that. So I'm not saying that there's a certainty, but obviously it will not necessarily be ensured. It will be difficult to separate, given the economics and the flow of cash for it. So the burden for external, the burden for the principal seems to lie externally. The burden for the interest is domestic, and that's difficult to actually separate in a solution. Now to Peter. Yes, I've just had to be honest, like you. I don't know under what circumstances the Exim Bank would be, under what circumstances it would be lending the government of Kenya. We also don't use very aggressive models. We tend to use very simple models at the IEA because we want tractable models that tell us something that we can say without having to say qualifications for why only this or that condition is met. So what do we think? Our back of the envelope suggested that the government of Kenya would have needed an accommodation equivalent to close to $7 billion in order to be able to forestall any possibility of a default in the Senate. That's a really, really, really long bridge. So 3 billion seems to suggest it's close there, and perhaps that might be the first part. But I don't know under what terms, because nobody's prepared to lend to the government of Kenya under the present conditions at very soft terms. So it will be a term that might be a little bit aggressive. If you remember, before the last administration passed out, a Eurobond that was supposed to be concluded, transaction that was supposed to be concluded, was suspended because the terms were too high. If you look domestically again, and the Euro bonds are being dated, they're being very heavily discounted. Weeks in a go, I mean, at a go, people who hold Kenyan debt and had confidence in the Kenyan economy a while back are not as confident as they were before. So those two put together suggest to me that times are really, really tough. So if Kenya can actually get facility and accommodation that would allow for that to happen, $3 billion would be substantial. It would come at a very steep price, but in our view, it's still not enough. It would buy us quite some time, but it's still not enough. Because if you remember, the Eurobond alone that is expected to be paid towards the end of this year, actually early next year, it itself will take $2.5 billion. So that leaves you with and then of course there's the payment that's supposed to be made for the SGR and a few other things that need to be paid, including domestic debt. So yes, it's a tough time. I think we need to hold our bag very, very tightly. But at the same time, I think, yes, somebody needs to come to the rescue. They'll come to the rescue at a very, very steep price. That stated, our intention today was just basically to look at it. We've seen a lot of news items, but nobody puts together a coherent picture. So we hope we've given you a data-based narrative suggesting what it is, where the gaps are. And as you can tell, in terms of borrowing, the gaps have been large. Part of the reason the gaps have been large is government seems to be having a problem refinancing and rolling over debt, both domestically and foreign debt. The terms that exist do not. And with the global terms and obviously the dollar strengthening as it was, without a depreciation in Kenyan shilling, it would be impossible for people to buy Kenyan debt. So let's hope that as the markets get improved, the currency markets on one side get improved, it'll be possible to do that. But we think at the same time, there's been an absence of fairness to counties. Counties have had to bear the brunt of government delays while the national government has, quote unquote, dispersed fairly comfortably. I mean, of course, with some exceptions to the ministries, departments, and agencies. So thank you very much, everyone.
Thank you. Thanks a lot to our two speakers for putting together this data, doing the analysis and making the presentation. So thanks a lot to Noah and thanks Kwame for the very insightful presentation. I'd also like to thank everyone who's the 50 of you who've stayed with us for the entire duration of this meeting. On behalf of the IEA, we thank you sincerely and we hope that this discussion has been useful.